Right. Good morning, everybody. Here's your spot gamma levels for today. Grab a screenshot. And I'll continue to remind you there's an email that comes out from Tier 1 Alpha. It's free. It doesn't cost you anything. It has really great levels for the Excel sectors, your major equity names, and the indexes. And then it usually provides some sort of insight on market breadth and whatever's pressing at the moment. So a great read. It's free, provides a lot of information and more levels than these, but some that even match these, kind of giving you a little higher, maybe a little higher confidence in them. So don't forget to sign up for that email. I mean, you got to love free, right? So one thing that I was looking at yesterday was this market net flow. This green line represents all of the options across the marketplace, right? It's not one individual name, and it's the call side. So these are call premiums bought versus call premium, bought and sold. When you stack everything in here, it kind of diminishes its look, but here's the puts and here's the calls. So with that afternoon, and here's SPY. So we take those off for a minute, get a better look at what SPY did. When you put everything on there, it really doesn't look like we did that much, but from 412 to 419, $7 move. And you can see how the calls changed, right? We're talking about from 517 into 518. So it's a 2-day view, just so we can kind of see the move over the last 2 days and how much them call premiums changed. There's numbers here on the right side. 0 is down at the bottom here. So the call premiums came from below, from in the negative into the positive, topped out around 27 and faded back to around 20. You bring them puts in. And we're sitting in the 50s. When it comes to options, newer traders probably just assume that everybody is buying things, but that's not always true. And a lot of times firms and institutions will do more selling than buying. So when you sell a put, you're bullish, right? It's not considered bearish, it's bullish. Just wanted to point out that right there, right? As much as those calls look really good on their own, once you actually stack them against those puts, got a lot of premium up there right now. That was yesterday's 0 day, right? You can kind of see how the premiums flipped over. We were running that is SPY, whereas that up there is everything. This is just for SPY. All right, so debt ceiling seems to be the reason for the season. We have a lot of Fed speakers here and around the world, European Central Bank members. There is the G7 summit. It seems like Zelensky's going to crash the party. He was supposed to appear by Zoom, but now he's going to appear live, appealing for, harsher sanctions and yada, yada. I was reading through some of this issue with the debt ceiling, and it really seems like the immediate focus is on the obvious, that there's not enough money to pay our obligations and we're going to run out by June. Seems pretty important, pretty obvious. It's in our face. But the backstory was that as soon as they raise that debt ceiling and Treasury starts grabbing handfuls, it's going to even more reduce the liquidity throughout the system. They had some numbers. I don't have them all off the top of my head, but it's going to feel like another 25 basis point rate hike as far as liquidity is concerned. That's what it's going to feel like to the banks, who are already stressed. And they had some charts. I'm going to hope to grab a hold of some of those, maybe share them through today. But global liquidity over the last 3 years had hit a peak, and within 1 year, so it was a chart that looked like a 3-year span of time until we got into 2022, and then in 1 year we are nearly all the way back down there from what the Fed did last year, and we're really close to being back to that low before Treasury does this snatch and grab. So if you're thinking about KRE and the banks and everything's fine, and it's not so fine. There's still a lot of issues. All right, so I had hoped to find what Powell was going to be doing today, kind of hear more about it, right? Because where they talk and what they're going to be talking about really matters. Otherwise, it could be a pre-recorded event, and then nothing is even going to be a risk. And then we do have rig count, and that's very likely not going to be a big deal. All right, we're at the level. There's been this level that we needed to hit for a while now to kind of maybe reset some things. Retail sales 8 o'clock, and then we have 10 o'clock and 11 o'clock. And that's pretty much it. So, your 0 days should be good to go after that. We finally have some volume this morning. It seems like the first time this week that we really had anything. It's the third Friday of the month, so it's OPEX. That doesn't always hold too much weight, right? It's not like triple witching or something like that, but it is OPEX, so it is worth keeping in mind. That will account for a little bit of volume, but obviously it's not going to account for, like share volume and things like that, and the options market isn't open yet. So while hedging and positioning with options and everything else doesn't all stay in just options, a small amount of this could be because of the OPEX, but not enough to be able to attribute that much, right? It's the first time this week we've been in the hundreds. It's still in a normalized range. 100 is what we expect to see. It had been kind of light earlier in the week. Something worth mentioning as well is the old buy the rumor, sell the news. So, the rumor is, hey, they finally seem to have a solution to the debt crisis. Everybody's finally on board. Maybe they're going to get it done just in time to avoid a crisis. And that gave us a really nice boost to finally get out of that range that we've been struggling with. But we are now looking at the other side of that coin, suggesting that, once they do actually announce that it's been signed and it's a done deal, that we could see the other shoe drop. We have an MDP again. Yesterday, we never hit the floor pivot, so it was a missed daily pivot. And we have another one again today, at least so far. We haven't hit it, 41.97. We are a considerable distance from the weekly pivot point. That's not overly extreme by itself. How far away we get from the 10 is more pressing than how far away we get from that weekly pivot point. But just like with all floor pivots, there are levels that we can add, right? Support 1, resistance 1, support 2, resistance 2, that sort of thing. And you got to kind of wonder, when we get this far away, where's the weekly pivot point? R1. $42.50. Nice round number. So I don't like the way that this one works. It moves the weekly pivot every day, as opposed to keeping it in the same spot all week, the way mine does, which makes more sense because you get that pivot set for the week, and that's what you get. It's not like you get to go in every day and change things up. Ah, well. So we have a very narrow Globex, and this implies that they haven't accomplished their work for the day. Me too. I hope you make it through. If it does die, grab your phone, right? It's on YouTube, so you'll be able to just grab your phone, log into YouTube, and hear it there. So this narrow IB gives us something that we can work with, right? We can measure this range and identify multiple levels to the upside and to the downside. It's worth noting this morning that we have a market maker move. So we take that market maker move and add it to the average daily range, and we're looking at another 1.5%. The average daily range would get us to 42.65. So if we add, say, another $15 onto that, 42.80, that would be through this voodoo line up here. And I think that's going to be a hard thing to do to get through that line. I say that, but we went through this one yesterday like it wasn't even there. I mean, we just punched right through it. 42.04. When that flow hit, you can see how aggressive it was, right? And that nice little trap there. Great little trap. And part of that push was just squeezing all the people that tried to short that. But we can measure the IB, the initial balance. We can measure all of the Globex, which I'd rather do, right? Which we got right there. Plot it to the upside, plot it to the downside, and it'll give you levels no matter which direction we go. There's no reason to guess or assume that we've got some kind of edge in determining which direction we're going to take. We just let it break out and run the levels whichever direction it happens to go. If you're finding it difficult to trade, just sit out as long as it's sitting inside of this, right? That's simple enough. Now there is enough room, right? There's enough room in here to be able to trade. And before COVID hit, this is what a trading day would look like in the ES, right? A 12 or a 16-point range throughout the entire trading day. You would have just about that much room to trade. And that's something to keep in mind for you newer traders who came in since COVID has been around, right? You came in since that crisis. You're used to a market that moves around 1% a day. And oftentimes we get that entire 1% plus some in the RTH session. You're going to have to try to figure out how to make money in a market that only moves 10 or 12 points throughout the entire 22-hour trading day. It's not about grabbing a hold of a contract or two and running it 60 points. I know those are great trades to brag on. I like to brag on a trade when I catch something that big, but those don't pay the bills, believe it or not. Those are just, haha, look what I did. Something to think about. But if you're finding it difficult to trade right now, try to trade when we get out of this range. It's a good rule of thumb. If you're sitting inside of the Globex range, it's probably going to be a difficult trade. Other than the edges, of course, right? You get to the edge, buy into weakness, sell into strength, and continue to do that until it no longer works. Like yesterday. If we do break to the downside, that daily pivot's going to be a little bit of a magnet. It is really close to the 4,200. We'll very likely overshoot that and get right into the pivot point. And then beyond that, we've got the ADR half at 41.90. And to get through that, we would already be through the 50% point of yesterday. So remember, we can half back. We can pull back to this 50% line. And as long as we don't close below it on the day today, that leaves us primed and bullish for next week. for a really nice continuation out and beyond, and start pushing into that 4,300. Somebody asked just a few minutes ago if this is a topping pattern and if we're done. Well, look at this here with the flag pull and the flag, and then another push and another flag. So these two are very, very similar. It just shows really nicely that it doesn't have to be that we're done, right? As much as this looks like a topping pattern today, it looked like a topping pattern yesterday. Having said that, Tasty Trades had gone all around the US and was talking about the aggressive contrarian trade setup. And they had some metrics and some criteria to it, but their main takeaway was if you get a market that moves really fast in one direction, and I believe it was 7% in 10 days or 10% in 7 days, something like that, that you want to just take the other side by default. And then there's, of course, something that looks like this, which is rally-based drop. And in a rally-based drop, you think about where the liquidity resides, because that's where we're going back to. Well, we did get back to it. We're done with it, threw it out the other side of it. So that rally-based drop is done. And going from 40.58 to 42.20, drawing it the way that I just did is fine, but we spent a whole lot of time here in the middle. So we really just need to be able to measure it from the last 2 days and into this morning. And I don't necessarily believe that fits Tom's criteria for the aggressive contrarian. It's 2.5%. It might feel extreme, but it's not enough, right? And we're going to look at the 10 here in a few minutes and be able to answer that question as well. Have we moved too far, too fast? And does it owe us a pullback? It's what I built that indicator to tell us, right? Now, if you remember yesterday looking at the 10-day, 30-minute volume profile, I mentioned that when we're at the highs, we expect to go to the lows. When we're at the lows, we expect to go to the highs, and that the lows were down here yesterday, and that we were going to lose those lows through the overnight and into today, as long as we didn't fall down yesterday, and we didn't, right? We've still got some lows here that we're going to drop off as the morning wears on. This bit is going to be gone, so that by Monday, unless we get below 41.13 today, that red box is going to be the new low. And so when we say things like, when we're at the lows, we expect to go to the highs, and when we're at the highs, we expect to go to the lows in that point by Monday is going to be 41.13. It's not asking for too much. 41.13 is going to be the lows of the 10-day volume profile for a while now, right? Unless we go back down there, because that is a Monday. So next week on Monday, that'll be where we start. That was a whole week later, and we're talking about, coming in on Monday. So we've got 2 weeks of data to get through. It's a 10-day, 30-minute volume profile with a TPO. It is more of a classic shape, right? It's not perfectly shaped yet. And as long as we stay up here, we're going to start to build that V out. So we'll have a classic B instead of a classic lower shape B. 41.36 is the point of control. We are very far above it, and there is nothing to slow us down if we do start to break. Just like that move to the upside in the last few days when there was nothing to hit, there's nothing to catch us on the way back down. it's worth pointing out how much volume there is at 4170. Now, volume is old, right? It's not like new orders, but there is a significant bump there, just not enough, right? So if we did start to fall today, I don't know that I would expect much out of that 4170 area. Maybe a speed bump. We can kind of see all that volume yesterday. And if I could turn on a TPO for yesterday only, it would show that we spent a very small amount of time right there. And yet you can see we had a significant amount of volume right there. The same thing here, and I pointed it out the day before, right? That actually had become the point of control. If we had spent just a few more minutes in that location, we would have moved that point of control up to that spot. That's how much liquidity, how much orders was sitting up there at that high of day. Talking about getting out and shutting it down for the day, right? But that's why we stack TPO and volume profile side by side here, right? When I combine 10 days worth and I can put a TPO next to it. It doesn't really work that way if I try it here. The TPO, if I put it on the right side, is either going to read everything or it's going to just read this. So, the other thing that I could do is just turn off volume profile and put TPO on right here. I don't need to. We can see really clearly we didn't spend very much time there at all. And the idea that there could be some trapped traders, if we really start to zoom in on it, we got there, right? Maybe I don't draw a very good line. That might be splitting hairs, but an argument could be made that we're not there yet. And if anybody tried to short that yesterday and they're still holding, they're going to want to get out if they get an opportunity. I would have thought being trapped like that and holding through what, 18-point pain, that they would have tried to take some sort of exit right here, but not yet, right? And in fact, it looks like people re-upped for another shot at the long. Either way, I would really focus on 4211, which is a cog line, and 4209, that zone, that 2-point zone between 4211 and 4209. We break below 4209, I really think they're going to abandon that position. All right, have we moved too far, too fast? Right now we're looking at the 10-day, and we're looking back over a 1-year span of time. How far has price moved from the 10 to the upside on average before it was too far away and we had to flip over and come back in the other direction? Well, we peaked out 3.84, maybe 3.82. That was a heck of a run, right? When we really outran that 10 for a little bit. And in fact, we had crossed the 10 that same day. That was a massive rip from a negative to a positive. So that's the highest. But really the flip point seems to be around that 2.25. Once we get about 2.25% from the 10-day, we seem to pause, consolidate, we let the 10 catch up, or we turn around and go back to the 10, or both. we're nowhere near that. We're only 1.25, a little bit extra. So we could still run another 1% away from the 10 before we would even have to consider the idea that we've moved too far, too fast. So, the 10's more dynamic. It kind of moves relatively quick. We can ask the same question about the weekly. Have we outrun the weekly yet? And some would argue that this one maybe is a little more important anyways. We peaked out at 5.3, but the average seems to be when we get past 2%, maybe 2.5, 2.75. We're nowhere near that yet. We're just sitting at a 2. So we're beginning to have that thought that maybe we've run too far, too fast, but we have some room here. I'd say as long as we're not more than 3% away from the 10-week, we don't have to worry about mean reversion yet. Oh, it's gonna revert, right? That's as sure as the sunrise, but it's not going to be so demanding yet. We do have next week's levels already. They don't count yet because the day's not done yet. So the indicator is still alive. And I still argue you're better off drawing these levels by hand, because this indicator, as good as Mobius did building it, it still can't read the data that it needs to read, right? It's kind of getting the same answers from a different path, which is fine when we're in a good, clean bull market and volatility is low. But, that's like the pre-COVID world, and we're not in that world anymore. So the range for this week coming up, 42.80 and 41.64. If you want just a little bit of a visual, how much has the volatility changed between next week and this week? They increased the volatility expectation for next week, at least for the moment, and that could change, right? This could contract through the day today, and by the time we get into the close this afternoon, maybe it will have shrunk. But that's where we're at for right now. Today's candle's not closed, but it did push through this trend line that I've got drawn. I did that. So until today closes, this breakthrough is just a wick through. After the end of the day today, if we're still above it, then it'll be a trend line break. It's something to keep in mind. It's really hard to try to identify where that would be on an intraday, right? As soon as I try to go into a smaller time frame, it's charting just doesn't work that way. You can swag it. I don't like that word. I got to find something better, but you can, kind of ballpark it. Yeah. We really got enough pivots that we don't necessarily need that one. That TRB setup, by the way, we made it all the way back up to the top of the range. I had mentioned yesterday, the first range, this is what it owed us, but you can look to the next level. We're there too. That's just about all that a TRB owes you, right? And that doesn't mean that we're done, just that if you were playing that setup, the setup is done. Now you got to play something else. To answer the question, it is a head and shoulders, as ugly as it is, right? It's an inverse head and shoulders. but an inverse head and shoulders is supposed to be at the bottom of a range, not at the top of a range. Now, there are analysts that'll tell you that an inverse head and shoulder can be a continuation candle and it can be at the top of a range. So as much as I am sitting here saying it shouldn't be there and that I wouldn't trade it, it is valid. It is an inverse head and shoulders, and it does imply that we could make that move to the upside. But I wouldn't trade it that way. Just because I can't resist. We talked about this yesterday. TRB set up an apple back to the top of the range. And all we had to do is get a nice little bounce off of the close. Oh, yeah. All right, so US dollar Japan kind of topping out a little bit. There's a line in the sand. We really don't want to get too wild with this, right? So when I put it on a weekly, we can see back in December that 138, 139 area, and it kind of lines up with another pivot point from July 18. So we're getting into this area where we've got this expectation of a pause or a stall, maybe even a rejection like we did the last time. In that rejection, we're going to be looking at gold to maybe find some support, right? Silver too. And you can see with bonds, we've still got a little bit of floor left underneath us going back to March. So, we broke this line in the sand a little while back, but I think we're still good to go for a little bit. We had an inside day breakout in Hong Kong. They did manage to bring it back in and close inside, but it's be worth watching next week. Japan's got econ tonight, but that's been a runaway freight train. Thanks, Buffett. Europe is still open. It's 1:15 in London. We do got a really wide TRB setting up here, but it hasn't had the breakover. It had an inside breakout today, but couldn't keep it very long at all and came right back in again. And the dollar made it through that 103 and got all the way up to 103.5. Now it's rejecting, pretty solidly this morning and coming back down. But if you guys remember earlier in the week, we are talking about the dollar above 103, maybe 103.5, we'd be looking at an S&P below 4,000. We're sitting at 4,200. I did caution that at some point we're going to start to see the dollar and the S&P both moving in the same direction, not against each other. And that it might not last either, right? It doesn't owe us a move like that. So you can see they're not lockstep with each other, but these moves in the dollar, they should have been, especially once we got above that 103.5, they should have been a smackdown to the S&P. And that's not what we got. Which means that move in the dollar hasn't happened for the same reasons that we have been seeing a move in the dollar, right? And I'm not necessarily talking about today or yesterday or even this week. The months and maybe even the last year or two, the moves in the dollar, the why behind the dollar moving. And why it's moving now. So really something to consider, especially when we look at it and we look for it to move into certain locations through the day to kind of give us a ballpark idea of what's going on in the market. Things is a changing. And it's not done yet. I don't have an answer to that, by the way, right? Like I don't know it all, and I certainly don't have an answer. But I can at least point it out and tell you that this is not what we've had. And there's very likely more changes coming. Some of our biggest threats right now are going to be in a more complex realm than you're used to. It's an FX threat. It's currency threat, global currency threat. A lot of times we just worry about market cap, a big name like Apple or Google taking us down. And sure, I mean, that's still a big threat right now, considering how much they've run too. And they're the only things holding up the market. But this with the dollar is, really kind of giving us a clue here that we got other threats and that it's not done yet. All right, we see the 10 years picking back up, had started to fade, but within the last 2 hours from, well, maybe a little more than that, 5 hours, we've got an inside day breakout in the 10-year. The dollar hasn't picked up yet, or maybe there we go. Keyword there is yet. We had dollar and yields rising together yesterday, topped out together, fell together, but we're not seeing that turn yet. Instead, we got dollar and bonds falling together. And we got the S&P sitting at the highs while we also have the 10-year breaking to new highs. Again, opposite of what we've seen a lot over the last year. All right, we're looking at SMH. The run was pretty clear from Monday through Friday, right? Or the Monday through Thursday, at least so far. That 4-day run, that's just wow. If we do start to turn, the target's going to be the white line there. I believe I got that as a 4 period. It won't matter, 3 or a 4, either one, it's fine. But 50% of that candle is going to be a line in the sand to get through. 132.2. Looking at it on the whole week, 128 will be 50% of last week's candle. And really, I mean, it kind of takes out the whole range, but I wouldn't measure the range that way. I just focus on that one candle. So that's your semiconductors. That's a heck of a move, right? This morning, semiconductors, they're still holding the top, but AMD already giving some of it back. NVIDIA. Micron had news yesterday, kind of a little bit of the reason for the move. Hasn't given it back as much as the others. And TSM as well. Those China ADRs, here's PDD. So far holding the lows. But it really looks like we got 60 on the table. JD. Really big gap down in the overnight. Puts us down around that 35 level. We can see how that lined up pretty close to that 35.09. Now you look at it on a monthly, we just got a really nice double bottom. Baba, its earnings were horrible. Yeah, I don't think this is going to be done yet with that earnings that they came out with. So we don't have the China ADRs. We don't have semiconductors. We don't really have banks, at least not regionals. We got XLF. So other financial institutions, but not necessarily their regionals. All right, so we can see that 50% line in the sand from this candle on 1st of May. It's a weekly candle. A little bit of a springboard. Now there's really nothing in our way until we get back up to the top of that candle. Got quite a bit of room too. It's at 33.43. Until we get there, there's nothing here that we're going to hit. That doesn't mean it's not going to go down, just that there's nothing that we're going to hit. We do have a major moving average, 50 period, but we jumped over it in the overnight hours. It's at 32.77. If we were to put a 50 EMA on, it would have shown up here instead of that SMA down there. All right, so a fade this morning in XLF really needs to hold that 50 line, 32.77. Otherwise, you're looking at a 50 line rejection, and it's a descending 50. And just like a descending 200, those matter, right? They're going to be hard to get through. 1.43 ADR. It does have a market maker move this morning of 0.5%. A little bit of volume sizzle already. More calls than puts, which is not necessarily a bullish thing. We'd want to go in and see if those calls were bought or sold to open. And we do have a market maker move. You know, that alone implies that there's some anxiety or some kind of threat on the front end. All right, we don't have tech. Remember, it's supposed to be tech and finance, not tech versus finance. So this morning, we got finance heading to the upside, already sitting on an inside day breakout and continuing to go higher. But we've got tech failed the inside day breakout and is sitting back inside the range. Sorry, Cliff, the idea of these morning briefings, as much as I love giving everybody a fish, is to teach people how to do these for themselves, right? So I really don't try to cater to your time frame or your needs. I go through the same steps every day in the same order so that you can learn how to do the steps for yourself, and then you don't need me or anybody else. kind of the idea. It's on YouTube, so you can catch the replay. These two are flipping places. Tech yesterday, finance yesterday. Flip those two over, it's what we have today. Now we've got finance up and tech kind of flat. Now, a line in the sand that I have been using forever is 0.5%. Right? If it's not up at least 0.5%, then it's really not up enough. And if it's not down 0.5%, it's really not down enough. I've been reconsidering moving that percentage value to 1%. Mainly since COVID, a 1% move is like the starting point now, when before COVID, 0.5% was enough to get it done. I don't really want to have to adjust to the times like that, but it is worth considering if you're getting too many names in the morning, right? If the idea of narrowing all of this down is you want to have 2 or 3 really, really good things to look at, so you're not trying to watch 15, 20 names when we come into the open. When the benchmark is 0.5%, that's pretty much what you end up with, is just too many names. So an adjustment for that is to use that 0.5%, or a 1% instead of 0.5%. If I used that 1% today, the only thing we've got is negative Asian market, like those China ADRs and Alibaba, PDD, JD. KWeb's really not that bad this morning, but emerging markets is likely to pick up on the negative side. Bitcoin's flat. Well, GBTC is flat, but BITO is up 0.75%. So, you know, when it comes to liquidity and Bitcoin, this grayscale Bitcoin, unless it's a real rip roaring morning, that usually doesn't pick anything up until we get closer to 9:30. All right, so we're looking for a little bit of help in gold, silver, gold miners, maybe something in those reflation trades, energy, oil. So we had that nice little bid back up, kind of building a base. You can see USO getting bid again this morning. So already we're sitting at that 65 and some change. This is really bullish to have closed way down here and then ran all the way up, have an inside day breakout, continued to run up, and now we're sitting above this candle. Yeah, it's really bullish to have moved that far, but This is a gappy wiki bugger. You can see all these big major gaps all over the daily chart. It could very easily just turn right around and come right back in again. So a line in the sand will be that $65. We get below that, that'll be your alert. Break below 64.5, that'd be your short. The bottom of yesterday would be a really good target. Maybe target 1, target 2, 63. And that's not asking for very much, right? All we're talking about is reclaiming 1 day's move from the 17th, where we went from 63 to 65. And really that move was a gap close. Well, depending on what kind of analyst you're talking to, it made it all the way back down to the open of the previous day, not to the close of the previous day. A lot of push in XLE as well, so it's not just crude. This morning, we're sitting all the way up here on that daily chart, right? So we've broken through all of this. $79.78 is the 50% mark of last week. And that's where we're hitting our head this morning. If we do continue this run in XLE, it looks like we got to fight that 20 period moving average, $80.50. That'd be where I would target. And just keep in mind, this is a very bearish chart, right? You can see how the moving averages are all spread out like a fork. We have no crossover at all yet, other than price just crossing the 4. Until the market opens, we don't even have a 10 cross yet. We are across the 10, but it doesn't count yet. So that gives us bearish momentum with bearish trend and bearish strength increasing. All right, I really encourage you to read the email from Tier 1 Alpha this morning. It came out, or it's going to come out while I'm streaming, so I haven't read it yet, but they're going to give you some upside targets today that will become pressing if we get another runaway day like we had on Wednesday, right? Not yesterday really, but Wednesday. That kind of move there. We will pin to one of those key levels if we run to the upside, right? And I haven't had a chance to read it this morning, So I don't know what those new key levels are going to be, but we're very likely near a call wall, right? And I started the briefing this morning showing spot gamma and their call wall. So you at least have that. Let's see if we can do that. Yeah, 42.10, and there's nothing else. So we'd have to use whatever came out of the publication. Large gamma 42.13, and then 42.32, 36, 61, and then 312. 312 is a bit of a reach, and all of those numbers that I just read are for the ES. For the SPX, 4200, 19, 23, 48, 99. There's going to be a lot of people today telling you that, oh, we've gone so far and we're topping out and this is a short. I'm not disagreeing that it doesn't look like a short. It looks like a great short. It really does. Especially how exuberantly bullish and happy everybody is this morning. But you know, some of the best moves to the upside come from everybody piling into the short side and then getting squeezed so bad that they puke up their position. So until we actually start breaking down, trying to short this is nothing more than just guessing or assuming that we've run far enough that it's time to short it. And to give you a little bit of a recap of why that doesn't work so good, look at June all the way to August of last year. Sure, we had some red days. Sure, we pulled back a little bit. We even paused and consolidated, but look at the size of those days. Big, massive, ripping days to the upside. Continuous back-to-back days to the upside. And look at how many of those happened on a Friday. There's a Wednesday, Thursday, Friday right there. And a Monday, Tuesday, Wednesday, Thursday, Friday right there. Here's another Friday. So just a little note of caution, right? This feels like they're going to yank the rug out any moment and the market's going to come down. It's what it feels like. But for goodness sakes, wait for a signal to short this thing. Otherwise, you're just guessing. Breaking back down below 42.10 would be a good start. 42.10, 42.11, there's a cog line there. Breaking through 4,200 flat, even better. Right, so maybe one would be an alert just getting through our own Globex low. 2, getting short at 42.11, and adding to your short at 42 flat. On the week, if we're going to continue this bullish momentum or this bullish move, we don't want to close more than 50% below yesterday. That's 41.88. That's one metric. And the other one is we don't want to close below 50% of the week that we're in right now. So how we open next week is going to be really important. That line in the sand is 41.67, call it 41.68. So on Monday, when we come in, if you miss the briefing next week, or if you miss Monday, a gapped up Monday will be a bearish signal, and a gap down Monday will be a bullish signal on the week. I will feel a lot more bullish if we're gapped down some, at least, coming in Monday. Everybody be careful, be safe, watch the news. It's going to be another debt ceiling kind of day, and we got a lot of Fed speakers. And I don't know how many of them are live and how many are recorded, how many are doing questions. I didn't have a chance to get into it, so I don't know. If you have the time, answer that question, right? It'll be one of the biggest pieces of information that you need for the day. Be careful, be safe, have a good weekend. I'll see you all next